Hello and welcome to State of the Economy. Today we have with us Dr. Arvind Virmani, former Executive Director at the International Monetary Fund representing India, as also a former Chief Economic Advisor in the Finance Ministry, to discuss with us the impact of the slowdown in China and the big financial crisis that China is going through presently on India, as also on other Asian economies, because a new narrative is already coming from economists in the West as also in the developing countries that the next recession will be made in China. In fact, some have said has already been made in China, the recession. And therefore, we thought in this edition we'll discuss China, which is a $10 trillion economy, which is the biggest, which adds to global GDP, which has largest addition to global GDP annually, which contributes. We often discuss the impact of US and Europe economies on India, but we rarely discuss in detail the kind of impact that China, which is a huge economy, has on Asia and some of the neighboring countries. So we have Dr. Virmani with us to give us some insights on this. Dr. Virmani also has done a lot of work on China, a lot of research, long-term trends in China. So tell us, Dr. Virmani, what is going on? China, by all accounts, is a consensus that it is slowing. And although they pumped in $600 billion after the 2008 financial crisis, the global financial crisis, they were the first to do it. And they indeed grew their GDP. They almost doubled it between 2009 and now, from roughly $4.5–5 trillion to $10 trillion now. But there was too much credit, too much liquidity, fiscal, monetary stimulus they pumped in, created a property bubble. Now there's a stock market bubble, there's a twin bubble. Where are they headed?
Okay, so very briefly, let me put it into the overall perspective, then we can come to details on this. So the way to understand is three different components. The first is the long-term trend, which some of us, including myself, have predicted since the end of the 90s, that the Chinese economy would slow down somewhere within this decade.
Yeah.
Very hard to say exactly when. So I had specifically said somewhere around the middle of this decade. And that is what we call catch-up growth. As the economy's per capita income grows, it generally tends to slow down. So that's one underlying long-term trend.
Okay, over a higher base, the growth rate slows down.
Yeah, it doesn't happen smoothly, but on average, that's what we have seen in Asia, whether it was Korea, Japan, and all the fast-growing economies. So that is one thing which was predicted, but obviously the timing can never be predicted with accuracy. The second was the global financial crisis. So think of that as a kind of trigger which made sure, or whether you want to think of it one way, that the Chinese economy indeed did slow down as predicted. So this trigger, of course, affected across the world, as you know and you just said, but it affected the export-oriented economies more. So again, in 2009, some of us, I actually spoke in Korea and said that the Chinese economy would actually suffer more than others because global growth and global trade and global exports were going to slow down. Now, that doesn't seem to be consistent with what happened. And again, you mentioned the reason. And the reason is the whole world actually got together and gave a fiscal and monetary stimulus in 2008-9.
Unprecedented stimulus.
Which brought the whole, most of emerging markets back up again, including India, including China. Now, the problem was that the Chinese kept pumping money.
But they didn't know when to withdraw.
That's right. Actually, we also delayed by a year or two and are suffering the consequences. Again, we can come back.
Here I just want to mention, Dr. Virmani, I remember Dr. Subbarao at the RBI saying that much of the world gave huge fiscal monetary stimulus. They entered the Chakravyuh, as Abhimanyu read, but they didn't. Nobody knew how to get out. I think that situation still exists.
Well, yes and no, because I was CA at that time, and of course I left. So some other persons took over, but I had said that this stimulus should be withdrawn as soon as the economy goes back to 8%.
Withdrawn.
No, withdrawn completely as if we reach 8%. And we reach...
Even the Americans are wondering how to withdraw the stimulus, right?
Well, let's not get diverted because that's another huge subject. So okay, let's come back to China. So what again, at the IMF, I was at the IMF from 2010 to 12, and I had asserted that this could not last. I mean, the growth cannot be pumped up permanently. So what happened in China was they created a bubble by going on pumping money into the economy, credit, because they control the whole credit system.
Yeah, sure.
So that has created
and they have a shadow banking system.
So the first, as you very correctly pointed out, the first bubble went into real estate.
Yeah.
Then when the real estate bubble was beginning to collapse, they started pumping it into the
stock
economy.
Markets,
But the underlying thing which has been going on is the growth has been slowing.
Yeah.
It has already affected the metal markets. This is where I disagree somewhat with the conventional wisdom. It's not because of the stock market or now. The whole overcapacity in metals, etc., has already affected
You're right.
the
Commodity
world.
prices actually have halved.
Yeah.
Across the board. Yeah.
So here the global dynamics comes in.
Yeah.
Again.
So tell us, what is the impact of this sudden halving of commodity prices on other economies around China and in Asia?
Quite right. So the thing is that even though the bubble kept pumping up the Chinese economy, the commodity prices actually were more heavily driven by the monetary, the QE in the global world. So both these things have happened simultaneously. The QE, because it's going to be changed, that commodity bubble collapsed, so to say. Good for us, because we are dependent on imports of commodities, so it's good for economies like that. But also simultaneously, the Chinese
economy... But is it unqualified good? Because I'm told that when commodity bubble, it bursts in such a precipitated way, it affects a large part of the economy whose revenues are driven by commodities, right? So,
So the problem is this, the economic actors always like smaller changes, slow changes.
Yeah, exactly.
So clearly, a bubble and a bust is a bad thing.
That's the point I'm making.
Absolutely. But that is a temporary thing. You know, the question is, what is the alternative? I mean, if you keep pumping up the bubble as China did, you can have a potentially bigger collapse. Okay, that's the sad thing. Hard landing.
So tell me, this collapse, this sudden collapse, will have a negative impact for at least about a year and a half, 2 years?
That's right. So
we'll have to suffer for about 2 years?
But we have to bring in the third element of it, which is that China's economy was not only export-oriented, it was driven by investment. Because Chinese state companies, provincial companies own so large a part of the economy, their profits have been driving investments. Okay. So there's huge overcapacity in tradable goods, which includes metals. So the reason is that it is not the commodity price bubble only, it's because they kept investing despite the fact that commodities prices are going down. So there's huge overcapacity.
So here the fear is, Dr. Virmani, that this huge overcapacity in China, if tomorrow, say, China slows down to, say, 4%, which is a possibility, distinct possibility, a kind of soft landing, 4 to 5%, there's a fear that they'll evacuate their excess capacity in commodities, steel, aluminium, what have you, onto other neighboring Asian economies. So how will that affect India? That's what I'm getting at.
Right. So they are basically the fact that they will do this. The only place where I differ with the conventional wisdom is they are already doing it. They have been doing it for 2-3 years. We are facing the effect. That is why our profitability of corporates is low. You know, it's not just domestic problem. It is that what I call the globalized corporate sector in India is already been suffering from this. So part of the effect...
So you're saying that the Chinese slowdown is already impacting a lot of economies...
Exactly.
Including Asia.
Including raw material exporters in Africa and Asia. So what I...
Australia, they export to China.
So where I differ from the conventional wisdom which is emerging is they are thinking of the impact all occurring henceforth. I am saying it's already occurred over the last 2-3 years.
And some more to come?
And some more will come. Yes. But again, there is a slight difference in my analysis. They only look at the the supply side. What I'm saying is, in some sense, the investment by these companies will also be affected.
Okay.
So the increment to capacity will go down, and that will be a positive. So it's not all negative.
Okay.
You understand what I'm saying?
I agree, yeah.
Because their profits are down to zero, they won't have the money to invest.
Okay.
If the bubbling, the credit stops, that means the investment will go down, and there'll be an opportunity for supply to catch up with demand.
Okay. Okay.
So there'll be two effects coming in. Right now, the effects have been both negative. More capacity, more push to export.
Okay.
If the Chinese economy collapses, there'll be two effects.
So essentially what you're saying that if over the next 2 years or 2 to 3 years, if supply catches up with demand and overcapacity and this poison is worked out,
that's right. It'll be good for us.
It'll be good for
everybody.
us.
Yeah.
But my point is, what happens in the next 2-3 years?
Quite right. There will be greater
What sort of pain will we suffer?
It's very clear. I always say people make a mistake when they think of China as a normal market economy. Yeah. They are competitive in many ways, but they are still a non-market economy. The Chinese party, it's not the government, it's the party has a big role. And that role we don't see because by its nature, it's very subtle. Yeah. Anyway, given that, there will be a huge pressure to somehow increase profitability or to reduce losses by pushing out. Okay. And we will have to watch out for it.
So at least the next 2 years, we can say forget about a 9% growth rate, 8-9% that we've been optimistic about?
Okay, now here it's a bit tricky. And this is where, again, I'm sorry, I'm giving you a lot of unconventional thing, but again, I differ with the conventional wisdom. I believe there is a two-track growth in India currently since the global financial crisis. Okay. There is the globalized part of the economy, which is basically big corporates.
Okay, and there's a non-globalized.
And the non-globalized. Yeah. So there is still an opportunity for domestic policy to revive that.
We'll discuss that in some detail, but after this, after a small break, please don't go and keep watching RSTV. Welcome back to State of the Economy. We are having a very interesting discussion on how a slowdown, a sharp slowdown in Chinese economy will impact India and other economies in Asia. Dr. Arvind Virmani, who's a former executive director at the International Monetary Fund, as also former chief economic advisor, Ministry of Finance, has given us some interesting insights. And so, Dr. Virmani, now you said that it will impact India until this whole overcapacity poison works itself out in China. Economies around China will get negatively impacted, and other countries are also alive to this. Recently, the Indonesian vice president said he's very worried about what's going on in China and its impact on Indonesia, which is also a relatively big economy. So now, until that happens, what should India do? You've said that there are parts of Indian economy which are linked to the global dynamics, but there are parts which are not. Now, can you just tell us, break this down for us?
Right. So, I've looked you mentioned that I do research occasionally. So, what I have done is I've looked at the IIP very carefully and divided it into three parts. One, the globalized sector. Second is the automobile sector, which is kind of in between because it's not totally globalized because the protection is still, that's one sector where actually import duties and so on are still quite high.
You start with the sectors which will get affected, like metals.
That's right, metals,
yeah,
okay.
Yeah, okay.
So metals,
steel, aluminum.
Right,
yeah.
so what I found was that this part of the sector had collapsed the most. And then we know it from globally, if you, the stock markets you look at, it's the metals and the other sectors. So a lot of the what we call the the non-differentiated sectors, which operate at global scale. So that's the best way to think of it. Is the metals is a great demonstrator of it. There are also certain types of chemicals, mass chemicals, etc.
And these are tradables.
They are tradables, non-differentiated products.
Yes.
Like differentiated product means you can have a shirt which costs $1,000 or $100 or $10. Those are differentiated products. Yeah. So it has a differentiated effect. Yeah. Okay, it's more complicated, but it's these standardized globalized products.
Tradable, globally traded products.
Exactly. So these have what the point here is. So what the tricky part, which I'm not 100% sure, calculated yet, is how much, a lot of people saying is Chinese growth, though they are saying is 7%, it could be 6% or even lower. Now, let's just for the sake of argument assume it's 6%. That means it's already gone down from 10% to 6%. So that 4% effect is already there. Okay? So the question is, how much more will it go down if it collapses? I doubt it could go below 4%. So really, it is in some sense only 1:2, right? 6:4 is half of the 4% is already declined. So only thing I'm saying is that the further effects are unlikely to be as huge as most foreign analysts seem to be saying.
So you're saying that the worst seems to be over?
Yeah, in my way of looking at it, and if we are right that growth has already slowed in China, most of that effect is already in the public domain, so to say. Now, but there will be some more effect, of course. And the second part is the stock markets have not been fully accounting for this. They've been optimistic that somehow that global economy will recover, Chinese economy will recover.
Chinese stock markets have crashed.
I know. I'm talking.
I know. They crashed 30% in the last.
So there's still, everybody has continuously been thinking, oh, everything will recover and we'll go back to at least, let's say, the 7-8% type of order of China. I'm just using that as a benchmark. Okay. But that's not happening. So what this crisis has done, their stock market boom and bust, has suddenly made a lot more analysts aware that the Chinese economy is much weaker than they probably thought. And secondly, this rosy picture of everything, including China, recovering and going back kind of to that 7-8%.
That 9%,
No, 9 nobody expected, but let's say China at 7-8 may also be too rosy. Okay, so that's the difference. So that's why all these uncertainties in the stock markets, etc., which itself has some effects, of course, on our capital flows, etc. But in my view, those are basically temporary effects till everybody adjusts to this new reality.
So, Dr. Virmani, I want to ask you how temporary, well, you just said that once the Chinese overcapacity works itself out, it may take 2 years or 3 years, things would normalize, and by then India would also be ready to sort of really take off. It would stabilize. Now, if you go back to Japan of the 1990s, some economists suggest that whenever there's a twin collapse, property as well as stock markets, then the recovery happens over a much longer period. It's almost like a saucer-shaped recovery. For 7, 8, 10 years, economy kind of stagnates. Do you expect something like that to happen in China?
So, again, a very difficult question. There's a whole bunch of, and some very
But is this a valid fear?
Right. I'll explain. But I don't want to give a simplistic answer, I want to, because this is important for many people. So the issue is this. My memory is that about 25% of the cases of this kind of collapse, you get stuck in the bottom.
You get stuck. For a longer period.
But in 75%, let's say 50%, you kind of come back slowly up, and only in another maybe 25. I'm giving you rough numbers.
Even US, there's a fear that US has also went through a housing and stock market collapse. So therefore, the recovery is taking so many years.
So, but this is much worse. This is a real bubble. That's why I emphasize that middle portion, as I said. Just like the Japanese one, which was a bubble. So, and of course, US was too, but there are some other complications there. So the question is this. My best guess is still that China could grow around 6%. And here I take plus minus 0.5. I would put a probability of about 50% and only about 25% in much less than that. But let's take that worst argument.
So in a sense, you're a China bull.
In a way, yes. But, I've been consistent on this because historically, they have actually managed the economy well. But what this stock market boom and crisis has shown me that maybe they are not as competent. So, in fact, I have actually increased my probability of it being going to 4-5% a lot, like 10 times. Earlier, I would have said 1%. Now, I'm saying 25. So there is a real probability, yes, that they could be stuck at that 4-5% level. And that goes back again to that long-term trend. There have been many...
Long-term 4.4 to 5% GDP growth level, right?
There have been many countries which kept the growth up too high, because they've kept it at 10% for too long and then refused to let it decline and not change their economic model, there are many countries which then kind of collapse. Collapse in this case, remember, means from 10 to 5 or 4 is a collapse.
Yeah, sure. Yeah, okay.
Okay, but as I said, I think part of that will be a forced realignment of policy. That old policy of just making profits and reinvesting and creating excess capacity is no longer viable. So that's what all this struggle has been, you know, between a soft landing. There would have been a soft landing if they had adjusted it faster.
In China,
yeah. If they had done it faster, not pumped so much.
Here, I want to, Arvind, I want your views on one very critical aspect of this boom-bust scenario in China, and some sort of comparison with India also on this metric. Now, here is the data. In the first boom that China, in the 2002 to 2010 boom, 2009 boom that the world enjoyed, China, during that period, China, with its forex reserves, $3 trillion plus, they funded their banking capital. They gave about $80–90 billion to their banks. This was post the Asian crisis around 2002. They actually recapitalized. They had
bad debts, so they had to recapitalize.
They bad debt, right? And India also went through a similar phase. If you remember, Manmohan Singh between 93 and 95, he recapitalized the banks. Now, there's a bank recapitalization, and after the bust, there's a cycle of recapitalizing banks and the banks then going a little down and then further recapitalizing. Now, China is again at a point where it may have to recapitalize banks. Right. It has huge reserves, which are export-earned reserves, right, by their state-owned enterprises. Now, when you compare that with India, India is also at a point when it will have to recapitalize banks, but there is the money. Now, a lot of analysts are saying that one of the key to India's growth recovery in this cycle of boom and bust, global boom and bust, not Indian boom and bust, is banking capital. How will we fix our bank capital, recapitalization?
So this links.
So how do you compare China and India on this metric?
Right. So this kind of takes me back to your original question of what's happening in India.
And that's what I'm coming back to the Indian problem.
Right. Now. So the issue here is why did this happen? You know, because as I mentioned to you, I was chief economic advisor till 2009. We brought the economy out of that recession. Sure. I still remember, you know, just a small anecdote which people may be interested. We were on a flight.
We can focus on the banking capital. We just 2 minutes left.
Okay, we have 2 minutes. Okay, so let's take the banking capital. So here the issue is, why did it happen? So it's very clear that there was a desperate effort. And I remember, because I was part of those discussions and I opposed some of this, to get funding into the infrastructure sector and particularly into PPPs and so on. I think this was forced lending. I think it was a wrong approach, you know, because you cannot do profitable investment unless the policy structure and the regulatory structure is there. If there is an appropriate policy and regulatory structure, the money will come. I have absolutely no doubt. So if the money is not coming, you have to change that structure. Otherwise, you create NPAs. That was one problem. The second problem was similar to China's. This one was different.
So in India, instead of addressing these issues, we are depending on banks to further fund.
Exactly, because they are public sector banks. The similarity was there also they are public sector. They are controlled by the government party, whatever you want to call it. That forced lending was in some sense similar. Okay. The other similarity was this optimism. Remember what I just mentioned, that everybody was optimistic that somehow all these are temporary problems and the whole global economy, everybody will recover. This was a mistake. And I say this with all due respect to everybody. I was at the IMF and I used to argue that. I said that the US will not recover for 5 to 7 years given their policy structure. So
you'll have to fix your own problems.
So you'll have to fix this.
So how do you fix our banking problem?
Right. So there are two. There's an immediate problem, which is a macro problem. So first you have to have the macro balance right. We may not have time to discuss, but the fiscal monetary policy balance, in my view, is still not appropriate. And second is what is connected with NPAs, what we call a balance sheet recession. Clearly, if you want quick results, we have a bankruptcy
you have to fix the balance sheet
act proposal. You have to fix it. Till the bankruptcy act comes, you have to find temporary solutions. And so if you want a quicker recovery, you have to sort that out. Yes.
Okay. So we need to pump in about, I'm told about 3 lakh crores over the next 3-4 years in banking capital.
What, or change or allow private thing, because as the Jalan committee said years ago, you can still government can have 26% and still control the banks if it really wants now.
Yeah, but the Sangh Parivar doesn't have the stomach to open up the banking sector. Anyway, that problem, let's see how it pans out. Thank you very much, Dr. Virmani, for talking to us on this subject. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.